Welcome to the Explainer. Today we're putting on our tactical portfolio manager hats to navigate a world that is frankly getting hammered by dual macro shocks. On one side, you've got the severe economic ripples of the Iran-US war and the massive disruption over in the Middle East. But on the exact opposite side, we're seeing an unprecedented, almost voracious global appetite for AI infrastructure. It's wild.
Okay, so here's our roadmap for this explainer. 1. The Hormuz energy shock. 2. Inflation and policy pressures. 3. Regional winners and losers. 4. The AI infrastructure shield. 5. Currencies and gold dynamics. And finally, number 6, the tactical manager's playbook. Let's dive right in. Section 1. The Hormuz energy shock. Look, the whiplash we've seen in the energy markets lately has just been historic. In the first quarter, crude oil rocketed up 83.4%. The catalyst for that? The effective closure of the Strait of Hormuz. We're talking about a critical choke point that handles 20% of the world's crude supply. But, markets move fast. By early May, we actually saw an 11% drop in Brent crude, taking it down to around $97.48 a barrel. And that drop was driven entirely by optimism around US-Iran peace talks and a proposal reportedly under review by Tehran. But hey, hold on. Let's not get ahead of ourselves here. As Chevron's CEO warned, physical shortages in oil supply are becoming a very real thing. And his quote brilliantly illustrates the lingering danger. He pointed out, even if the strait reopens, normalization in shipping and trade flows could take months. So uneven distribution and declining buffers mean that localized shortages and inflation fears, they're going to remain highly elevated regardless of whatever immediate diplomatic headlines we see today. Section 2. Inflation and policy pressures. Now take a look at this massive disconnect. Since late February, international energy prices have jumped over 40%. Yet, if you look at the weighted domestic retail prices in Asia, they're only up about 19%. So, what's going on? Well, governments are basically frantically deploying price caps and subsidies to cushion the blow for everyday citizens. But guys, this is a ticking clock. The longer energy prices stay high, the heavier that fiscal pressure becomes, and the debt financing for all these subsidies will inevitably have to go up. And eventually, that pressure is going to burst right through. We're seeing new forecasts pushing inflation meaningfully above central bank targets in places like the Philippines and Indonesia. This energy-led inflation shock is literally forcing central banks into a hawkish policy reset. We're looking at a shift to net tightening. And what that means is a bear flattening of yield curves, where short-term yields are rising faster than long-term yields, simply because the markets are pricing in these really elevated near-term inflation risks. Section 3. Regional winners and losers. From a tactical standpoint, geography is completely destiny right now. Just look at the stark contrast between the US and Europe. The US has been upgraded tactically because, it runs an energy trade surplus. It's actually relatively insulated from these massive price spikes. Europe, on the other hand, they've been downgraded. They're dealing with converged earnings momentum and just a deep structural vulnerability to any extended energy supply disruptions. It's a tough spot. Over in Asia, the pain is super acute for net energy importers. This petroleum supply shock is projected to drag global GDP down by about 0.5% to 0.6%. India, the Philippines, and Thailand are taking the absolute hardest hits here. India is particularly vulnerable. They're suffering this brutal dual blow from their massive reliance on oil imports, which is then compounded by their heavy trade dependence on exports to Gulf nations. Plus, as you can imagine, surging energy costs are just heavily destroying demand in tourism and air travel all across the region. Section 4. The AI infrastructure shield. All right, here is the plot twist. While energy prices are out there wreaking havoc, the AI infrastructure CapEx cycle is actually creating an economic shield for specific markets. The pipeline is incredibly clear. This voracious demand for AI compute drives a massive need for advanced semiconductors, and that translates directly into a historic export boom. In Q1 alone, exports surged 38% for Korea and a massive 51% for Taiwan year over year. Think about that. This semiconductor supercycle is literally cushioning these economies from their ballooning oil import bills. The most crucial point here can be summed up in just a single number: 93%. That is the staggering consensus expectation for 12-month forward earnings growth for MSCI Korea. It perfectly illustrates how having deep exposure to AI infrastructure can almost completely overwrite the negative macroeconomic drag of a global energy crisis. It's just wild to see. China also stands out as remarkably insulated, though honestly for a wider variety of reasons. First, they have a massive buffer of over 200 days of strategic oil reserves, plus direct access to Russian energy.
Furthermore, while their low-value exports have definitely struggled with higher input costs, get this. They imported a record $135 billion in semiconductors in Q1 just to fuel domestic AI. And on top of that, their higher-value green exports, like EVs and solar panels, are absolutely booming as this energy crisis accelerates the global energy transition.
Section 5. Currencies and gold dynamics.
The data we're tracking here shows a clear story of increasing divergence. The Chinese yuan and Singapore dollar are really proving resilient, and that's supported by current account surpluses and targeted policy measures. But then look at the other side. The Indian rupee, the Indonesian rupiah, and the Philippine peso are all depreciating significantly. Their fundamentals have deteriorated sharply just due to the terms of trade shock from those higher imported energy prices, and that's forcing their central banks into a very defensive, tightening posture.
And amidst all this fiat currency volatility, you have got to look at gold. It's up roughly 50% year-to-date in 2026, making this its absolute best year since 1979. And look, this isn't just a fleeting trend. It's a structural rally. Investors are losing confidence in sovereign debt, like U.S. Treasuries, mostly due to rising deficits and these explosive debt trajectories. So they are increasingly turning to gold as a primary safe haven and a core structural portfolio diversifier.
Section 6. The Tactical Manager's Playbook. So what do we actually do with all this? Here is the playbook. For global equities, our 3-month stance is a cautious positive, basically favoring the insulated U.S. and the AI-driven parts of Asia over a highly vulnerable Europe. On U.S. government bonds, our stance is strictly neutral across the board. The inflation upside risks and that bear flattening yield curve we talked about just make it way too dangerous to be overweight. Cash is also kept neutral, so we maintain flexibility for rapid deployment into risk-on opportunities. And in corporate credit, high yield is heavily preferred over investment grade right now. We're chasing those attractive all-in yields, even though spreads are historically tight. But perhaps the most vital lesson for any tactical manager right now is embedded right here in the historical data. The start of 2026 brought a vicious boom-bust cycle to Asian equities. And sure, it is incredibly tempting to just panic and sell during these geopolitical drawdowns. But the data proves that exiting the market and missing just the 5 best recovery days drastically destroys your long-term compounding returns. Process and discipline during volatility are literally everything. Which leaves us with this final thought. We are witnessing a fundamental realignment right now. From energy supply chains being rewritten overnight to AI completely redefining the boundaries of economic growth, the landscape has entirely changed. So you have to ask yourself, in a world of shifting choke points and dual macro shocks, is your portfolio really positioned for the next macro reset?